Good afternoon, everybody. Thank you for joining. Can somebody just quickly post in the chat that they can see the presentation and that they can hear me okay, if that's okay. Perfect. Fantastic. So, thank you everyone for joining me. This is a short presentation on how you can, in effect, keep more of your own money. If you have any questions as you go along, please feel free to put it in the chat box and would rather answer as we go along. There's a Q&A session at the end, but if there's anything that's relevant to the slide I'm presenting, then at least we can deal with it there and then. So, who am I and what qualifies me to talk to you about how to save tax and extract more value out of the business? Well, my name's Carrie Stokes. I am the director of Spotlight Accounting. I am a chartered accountant and I run my own accountancy business, but also I'm a business owner myself, and somebody actually told me off for introducing myself as an accountant. So I first of all run a business. I'm growing a business and face all the usual challenges in navigating that growth. I do need to give the usual disclaimer that this presentation is intended for educational purposes only. It doesn't constitute formal legal or professional advice. And if you were thinking of putting any of these strategies into place, please speak to a professional advisor before so, because everybody's situation is different. So what am I going to cover today? Just a brief introduction. I'm going to talk about a typical accounts process that business owners go through, how your accounting process should work, what are the key factors to getting it right. I'm then going to talk a bit about stealth tax, different methods of extracting value out of your business, and then I am going to summarize at the end. And then with a question and answer. So I want to talk to you about a typical accounting process that we see time and time with business owners. I'm going to take a 31st of March year end as an example. You've got 9 months in effect to get your accounts together and submit your tax bill. What typically happens is you spend the first 3 years driving sales and getting into the new year. We then, with March year ends, typically hit June, July, August, September, where it is holiday season. The 1st of January seems miles away at this point. Then the 1st of September hits, you think, crap, I need to get my accounts together. And there is a 2-month process normally where you're preparing your accounts. You submit your accounts to your accountant when they're pretty much at the most busiest time of the year. And then what happens is you're hit with your tax bill almost a month before it is due to be paid. And at this point, it is too late to do anything about it. You haven't set the funds aside and it is sheer panic. I'm going to use what I call worst practice that I've come across just to give you an example of how we started working with clients that were used to working in this position and how we've transferred them into a position where they're in control of what they're drawing out their business a lot better. So typically I'm going to use Will as an example, and this isn't a client, I'm using my children's names to be fair in case I cause any upset. This is Will, who is a consultancy business. They turn over £150,000. He's got costs of £93,000 per his zero, which is a profit of £56,000. He's therefore expecting a corporation tax bill of £13,000. He's drawn dividends of £30,000. So he's expecting a corporation tax bill of £13,000, a tax bill of £3,171, and a total tax bill of £17,000. The accountant then deep dives into his accounts, which is what we do, looking for expenses that aren't business. And lo and behold, in accountancy fees, there's some personal tax planning work the business has paid for. In office costs, as he's put his full Sky bill through. In travel, the accountant looks and he's been to see a conference, but he's taken all his family with him, so he's put all the flights through and they were disallowed. In consultants, there's £20,000 worth of legal fees, which aren't anything to do with the business, it's a personal claim. In sundry expenses, there's £500 of Amazon spend, which is clearly personal. And in motor expenses, he's put the lease of his personal car through. So when we've then come to do the accounts, the profit is actually £87,000, his tax bill is £20,000, and his personal tax bill is £9,660. So the accountant lumbers him with a £30,906 combined tax bill when he was expecting 17. So this is a big shock, and that is going back to the previous slide. It's all done last minute, it's all done on as a reaction, and he hasn't got that money because quite frankly he's spent it. So contrary to popular belief, as an accountant, I believe our job is not about eliminating tax. It's about making your business work for you. There's a reason you're in business. It's about looking at the whole picture. So it's looking at your personal circumstances and your business circumstances. And tax motivated decisions are often bad decisions. It used to be pub advice, now it's what ChatGPT spits out. ChatGPT can't see the whole picture. So, for example, we were talking to a client yesterday who'd gone down a ChatGPT wormhole about saving income tax on his property portfolio, but it didn't navigate an inheritance tax point of view. So he's looking at the holistic view. And it's about not one size fits all. What suits you in your business doesn't suit your best mate's business, because you might have two identical businesses. One might be building to grow and sell, and one might be a lifestyle business. And how the accounts and the tax side of that works is completely different. But as a principle, your business is there to give you the financial freedom to do the things you want when you want to do them. And as a business owner, you're constantly juggling three freedoms. That's money freedom, time freedom, and mind freedom. And it is which one of those is pulling at the moment as to where the business decisions need to be made. Now, I believe there are three fundamental things each growing business should have. One is a business plan that tells you where you're going. Two is a financial forecast that tells you how to get there. And three is interim accounts. Where are you on plan? So if you're pulling dividends at a rate of £5,000 a month and you're not looking to see whether the company's making enough money to cover that, that's going to cause a problem. I look at this as the Waze app of sat navs, and it is just making sure you're on track to get to where you want to go. So I'm going to use Will's business, which is a combination of bad habits that I've come across in my practice and my business personally, just to demonstrate how you can extract value out of your business in different ways and make your business work for you. So firstly, I'm in business to make a profit. As much as I love what I do, I am here to earn enough money to give me the lifestyle I want. My family are my key driver, and this has changed as my children have got older. I want 3 holidays a year with my kids to make memories. I want the flexibility to be there when they need me, and I want to be present at home when I'm with them. I also want Fridays out of the business. As this has been delivered on a Friday, you can tell I haven't perfected my goals yet. I want to build a pension pot for the future, and we have property investments, and I want to build capital value for retirement. And like I said, this changes over time. And again, it's really important sometimes to step back and look at what you're looking to achieve. And this is the real. So when I'm making a decision for Spotlight, these are the key things that affect what my decision-making process is. So I'm going to go back to basics and go through a few of the terminology I'm going to explain today. Sorry if it's teaching some of you to suck eggs, but I think sometimes we have to strip back before I can explain the process that we run through. So the first fundamental to get it right is to remember that company money is not your money. The company is a separate legal has separate legal identity to you. It has its own tax bill, and in most cases you have 2 hats to wear. One is the director that runs the company, and 2 is the shareholder that owns it. With your director's hat, it is your responsibility to run the company to give the shareholders the return on their investment. The second one, and I know I'd say this as accountant, but it's really important, is to keep your records properly. To use Xero or an equivalent software, you can use receipt capture to automate your receipts. And if you don't have time to keep your books, outsource it, because without your financial information, you cannot make informed decisions for your business. Even to the base level, we've got a client that is a vehicle rental business. He knows how many rentals he needs to do a week to break even, and he just needs to keep an eye on the number of rentals and his costs, and he's got the accounting software to do that and keep an eye on it. Tax account, again, it's really important to keep a tax account and save your taxes separately. If you have a March year end, you are earning money from April, so you're incurring cash on behalf of HMRC from the beginning of April. If you do not put that tax aside, you can end up with a real problem when almost 2 years later your tax bill is due. And the other key message to point out, it is your business, it's your numbers, and it's really important you understand it. As an accountant, we can help you navigate it. It's no problem, but ultimately you cannot put all responsibility on your accountant for your financial position. If you don't understand it, work with your accountant to get your head around it. So I just want to run through the types of expenses that you have, because sometimes, again, this can cause confusion. So there are 3 types of expenses. There are tax deductible expenses. So these are expenses that the taxman put in tax jargon into the presentation that are wholly and exclusively for your business. They're tax deductible and they basically reduce your corporation tax bill. If you rent a premises for your business, that is tax deductible, and that cost comes against your profits and reduces your corporation tax bill. You've got non-tax deductible expenses. So these are expenses you're incurring that are for the business. The company pays for them, but you don't get corporation tax relief on them. The main example of this is client entertaining. It is an expense for your business when you're taking customers and clients out, but it isn't allowable for corporation tax. However, it's better that the company pays for it because it's coming out of company money rather than you paying for it personally out of money that has suffered personal tax on it. And then there's personal expenses. These are expenses that are just not allowable to be put through the business and go to the director's loan account. So in the example of Will, it is where he's gone to a conference, he's put through flights for all his family, it isn't allowable, so it gets put to the director's loan account. The director's loan account acts like a bank balance between you and the business. So if the company pays for something it shouldn't have and it's gone to your director's loan account, you've either got to clear that through dividends or pay it back to the business. So I just want to talk about stealth tax, and this is the real sort of issue for business owners at the moment. Now, most limited company owners take their remuneration out of the business through salary and dividends. They tend to take up to the 40% tax threshold, and the last time that was increased was in the tax year 2021-22. Sorry, it increased in line with inflation. At that point, the basic dividend tax bracket was £50,000. It's currently 50,270. If it had been increased in line with state pension, the basic rate tax band today would be £60,177. So business owners are left with a decision. They either keep their drawings in line with inflation, which would cost an extra 4,226.27 in tax, or they keep their drawings in alignment with the basic rate band. Now, 50,270, when you've been used to and built a lifestyle around that level of income for a number of years, is really hard to stick to at the moment with the cost of living, the interest rates going up. It is costing more to run a household. So what we are finding is directors of of the businesses we work with are either having to suffer higher rate tax or they are struggling to maintain their household on the lower rate salary. Now, just I'm a visual person, so I'd rather see things in graphs than numbers. So personally, we take up to £60,000 a year out of the business. That is £60,000 because we still get our child benefit. Now, if you look at this chart here, 50,270 is the basic rate tax threshold. We're sneaking into the higher rate. So from April, we're going to be paying 35.75% on some of our dividends. However, if the government had kept thresholds in line with inflation, we would only be paying 10.75% on our dividend tax. Now, this doesn't just affect directors, this affects people that are employed because obviously the basic rate threshold applies to all taxes. So what is the solution to the stealth tax and the basic rate threshold not increasing? Well, the solution is alternative value extraction from the business. It's looking at different ways of drawing value. It's getting the company to pay for things that they can pay for. It saves personal tax. It saves business tax. And it's all about marginal gains. So it's looking at a number of ways of extracting value in a different way to be able to make your business work for you a bit better. So I'm going to talk about salary and dividends first. In most cases, for companies that are paying directors, the salary that you pay yourself is 12,570, and it will be for 26-27. So I should have explained at the beginning of this, these figures are for the next tax year, not this tax year, as we're so close to the tax year end. So the first thing you can look at is employing a spouse, civil partner, or family member. They must have a role within the company. And again, children, once they have their national insurance number, you can do it a bit earlier. If your children generally work for the business, you can pay them as well as your spouse or civil partner. The other thing is you can give shares to family members. There's a £500 dividend allowance that everybody has that you can utilise. That if it's not, if you're transferring shares to someone that isn't your husband or wife, there are capital gains implications. And there is also alphabet shares to consider. Now, typically, husband and wife business might own 50-50 shares, and they've got one ordinary share each. That means if you declare a £4,000 dividend, it's got to be split 50-50. Alphabet shares enable you to declare different dividends on different shareholdings. So we have clients where maybe the wife has a part-time job and has less basic rate tax band available. So what alphabet shares enable is different dividends to be paid, but that aren't in proportion with their shareholdings. So if we look at our case of will, and this has happened to us before, in the scenario I ran through when we'd adjusted the accounts for the things he put through that you shouldn't put through, we ended up with 12,500 salary and 53,562 in dividends. Will actually has a wife, Lucy, who actually does work in the business doing quotes, dealing with suppliers, doing all the day-to-day admin of the business. So in theory, he could pay Lucy 12,570 and split the dividends. As a result, all their income is taxed at the basic rate tax band, and he hasn't got this balance in the higher rate band. Putting that into numbers, he had a combined tax bill of £30,906. By paying Lucy and salary and splitting the dividends, his combined tax bill was 18,700. One thing he also saves, if you look at the line, is employers' national insurance. When you're paying one director, you don't qualify for employment allowance. where you pay two up to a certain level of income, he saves 1,136 in national insurance as well. The next tax saving or way to extract value out of your business in a different way is through pensions. Your limited company can make employer contributions to you. You need to be a member of a registered pension scheme. There is a 60,000 annual allowance that you have. You just need to be careful of the wholly, exclusively, and necessarily rule. And I will show you in a minute why we just don't use the full £60,000. It's got to suit you. And then also, if you've got employees, another way that you can save tax is a salary exchange pension scheme, basically where an employer gives up a salary in exchange for employer pension contributions. You save the national insurance element of the pension. There are HR implications, and also there is a £2,000 limit coming in from April 29. I'm not going to go through the detail of this in this presentation, but it's just to make you aware if you've got any employees that you are paying pension contributions for, there is the option to save the national insurance. So pensions, are they worth it? And so I have got in my target that when I retire, I want to have a £500,000 pension pot. Now, I didn't have much of a pension when I first looked at this. And so I decided that, and this formula has come from a pensions advisor that we work with, assuming a rate of return of 7%, if I contribute £264,000 out of my business into the pension scheme over 19 years, I will have received corporation tax relief on that 264,000. In theory, working with the right advisor, that pot would have grown by 244,347. That will have given me the 508,000. And also, providing Rachel Reeves didn't put another stinger on it, 25% of that I will be able to pull out of my pension pot tax-free on retirement. So the next one is company cars. So in summary, if it's petrol, diesel, don't put it through the business. If it's hybrid, speak to your accountant because it depends on the mileage, the range on the battery. Again, it is getting less beneficial to put hybrid cars through. If it's electric, yes, put it through the business. The company can pay for the running costs. Charging at the workplace is not a benefit in kind. And again, that applies to employees as well. The company can pay for the installation of the charger. And again, when you're charging at home, you can reclaim the running costs through the business. So this is my personal example. Anybody that knows me will know that I drove a Mini Cooper, that I was a convertible, that I was emotionally attached to for 10 years. It was time to say goodbye to it, mainly because I couldn't get a 6-foot sun in it. We went to look at replacing the vehicle personally, and the cost of that vehicle was 37,280. For me to pull dividends out of the business it was 35%, so we've rounded up to 36. I would have had to incur dividend tax of 20,743, which was a gross dividend of £58,000. If I then grossed that up for 25% corporation tax, I would have needed to clear profits in my business of 77,364 to buy a car personally, or I went electric. Again, up until this point in time, for me personally, it wouldn't have worked because we'd got a vehicle that we needed to tow. So that we didn't have the towing requirement anymore. So at that point in time, it just made sense for me to go electric. Now, there is benefit in kind on an electric car. Using the example of the car that I've got, having the car restricts my dividends of £3,095 a year, but I pay £619 on that benefit. The business pays £464 and runs the car for me. So at the moment, it is a lot more tax efficient. and a lot cheaper for me to be driving an electric vehicle that the business runs. I also like the fact that the taxman's paid for more than nearly half my car. The next thing I want to talk to you is about loans. So it can be more expensive to borrow through the business than personally. So if you've got personal savings in the business, you can lend money to the business. You can charge interest on that money. If you do, there's a quarterly reporting requirement, but it is a way of one, earning more money on your money and also saving the company money, leaving more in the pot for you to spend elsewhere that works for you. Employee loans. So again, you can loan employees and directors can receive £10,000 from the business tax-free. The only sting in the tail with this is if it's a director's loan. So if you borrow money from the business and it's not repaid within 9 months of the year end, you pay what is known as Section 455 tax at the higher rate of dividends. However, I've explained to you at the beginning of this, one of my key objectives is to build a property portfolio. So what we have done is put a group structure in place. This is a simple version, and we've got a building client that does this. They have a holding company, and underneath you have the trading company and the property company. The trading company can lend money to the property company tax-free because it's within the group structure. If this holding company wasn't in place and you had two separate companies that you controlled, it can be deemed to be an indirect director's loan account. So we have had instances where we've got a client that's come to us, they own two businesses, they've bought a property in a separate business to the trading company. They've lent it £300,000 and we've had to tell them they've got a £100,000 tax bill on the Section 455. So this is where the holding company enables us to loan money to the property development company without having to incur any director's loan tax on it. The other thing about this structure as well, and again, it is not, I haven't got the time to go through it in this presentation, but if the trading company was sold, the holding company sold the trading company, and again, providing Rachel Reeves doesn't put another clanger on this, there is what is known as significant shareholdings exemption. It's a bit of a tongue twister, but the holding company can sell that company in effect, not pay any tax. It does provide an issue for the owners because you've got to pay tax on getting out of the group structure, but this is where speaking to your accountant about a holding company structure can really help make your business and your investments work for you. Business assets. If you personally own offices that you have, you can charge rent to the business for those offices. Use of home is different. We've got a client that has a farm with outbuildings in that the business runs from the outbuildings. It's actually better for her and more tax efficient for the business to pay rent than to pull out dividends. And again, it is down to individual circumstances as to whether this is right for you. Personal use of business assets. So again, the company can pay for assets that you use, providing there is a small amount of personal use. So for example, iPads, phones, laptops, again, make the company pay for it rather than you paying for it personally. You do have to be careful with duality of purpose and that you're not taking the mick. So if you've got 2 members of staff, you can't buy 10 iPads, if that makes sense. Employee benefits, relevant life insurance. So there are certain policies that your business can pay for rather than you personally. It's a good inheritance tax planning tool. I'm not a financial advisor, so I'm not going to go into the details of these products, but there are policies you can take out that pay on your death. So for example, and we had this last year in 2024, we had a successful growing construction company, and the owner had a stroke, and unfortunately he's no longer with us. Now, the business, we sold it, but there wasn't enough cash in the business to keep the company going. So again, there are policies that will pay out on your death that will pay into the company. And if you've got employees, it will enable the business to be purchased and give value to your family. So again, these policies don't have to be paid for, they can be paid for by the business. And again, speak to a financial advisor about these policies. In our situation, we have to have life insurance as a requirement for our rental properties. It's under a relevant life policy. The business pays for it rather than us personally. Pensions advice. Your company can pay up to £500 a year for pensions advice, tax-free per employee. So we've already talked about how pension contributions can help reduce your tax bill. We've talked about the relevant life and the inheritance tax products. Again, the company can then pay £500 each if it's a husband and wife business. The company can pay £1,000 to speak to an advisor about these products. Mobile phones. Providing they are used for business use, the company can pay for your mobile phone bill. You just need to be careful that the contract is in the company's name and the direct debit is coming out of the business. Staff functions, you can have up to £150 per head tax-free on staff functions a year. And one of my favourites that often gets forgotten because they don't think it's a lot of money is trivial benefits. You can pay your staff and yourself a non-cash benefit of up to £50, and that is tax-free. As a director, you've got a £300 limit on it. It can't be performance related, so you can't give a voucher in exchange for sales targets, but if your staff has a birthday, you can have a trivial benefit. And what we do is we take £50 vouchers and save them up, and it goes towards Christmas. Other benefits, lunches and snacks, providing it is provided to all employees, they can go through the business. Medical insurance, there is a benefit in kind on medical insurance. However, putting my business owner's hat on, my staff all have vitality cover, they have private medical insurance cover. One, because they get treated quicker and they are in work, but also it provides discounts. It's promoting health in the workplace. It's not just the cost, there are other benefits. We get free cinema tickets, we get discounted holidays, we get discounts on trainers and sportswear. And while at first you think actually it's another expense for the business and I'm going to have benefit in kind tax on it, the right medical insurance policy can actually deliver more benefit than the cost. Again, I'm not a financial advisor, so I can't advise on the right policy to take. There's bikes and equipment that you can purchase on the Cycle to Work scheme. If you've got a gym and sporting facilities on site or childcare support on site, that can be tax-free. The next area to look at is business expenses that can be paid personally. Home working expenses. HMRC offer a flat rate of £6 a week. You can claim a percentage of the cost. So, for example, if you live in a 4-bedroomed house with 2 reception rooms, one of those rooms is exclusively for business, you can claim a sixth of the cost. If you've got a mortgage on your property, you can only claim the interest element and not the repayment element. The other thing you have to be careful of is if you're claiming it as rental, as on the cost basis, it can be deemed as rental income. If you've got other rental properties, you'll be taxed on it. If you haven't got rental properties, there is a £1,000 allowance. So if your claim is over £1,000, it can cause more tax than you're actually saving. Mileage claims, the rates have not changed for years. It's another thing that just has not been addressed, but you can claim 45p for the first 10,000 miles you incur for your business and 25p thereafter. The amount of times this gets forgotten is is quite shocking because this money can be pulled out of the business tax-free. You can't claim mileage if you're running a company vehicle. Just remember that home to office is commuting, but if you go home client to office, that is allowable. Subsistence and entertaining. Again, I've mentioned it before. While entertaining customers is not tax deductible, you can use the company money to pay for it. Subscriptions, if you've got music in the office, there are licenses you have to put in place, but again, that subscription can go through. If you listen to audio books for business, the business can pay for it. Now, one of my favourites is points reward cards. We have an American Express and Capital and Tap card within the business, and we pay for as much as we can on these credit cards. On the property business, we pay for most of the refurb on the credit cards. And what happens is you get vouchers for the spend. Now, I think last year we had about £1,200 worth of vouchers from spending on these two credit cards. My favourite instance is a client that tried to pay a £150,000 bill on it, and that would have created about, I think it was about £3,000 in vouchers, but he couldn't get it through. And again, air miles. I don't understand it, but we have clients that play the American Express card game, and I opened an American Express card, and I ended up with a free flight to Doha and a holiday on these vouchers. So again, it doesn't seem like it's worth it, but actually, when you see the reward you get through, it is quite beneficial. So, Carrie, that really doesn't sound like a lot. Is it really worth the hassle? So, I'm going to share with you, this is my example of how we draw money out of our businesses. So, my husband is referred to as maintenance in our office. He's paid £1,200 pounds a year through the business. He also has shares. I actually contribute 9,360 into my pension scheme at the moment. Using the group structure, I don't have to loan £20,000 a year and pay out of the business and pay Section 45 dividend tax on that. There's an iPad that I use for business and we use personally. My life insurance policies are 4,653. That covers a lot of rental properties. Pensions advice, £500. Mobile phone bill, 900. I have my trivial benefits. We have our tax staff functions. I've got my company car. The company pays the charging of my car. We get £1,200 worth of points rewards. And the medical insurance is 1,767. That adds up to an extra 75,540 I pull out of my business. And the tax saving against taking that as dividends is 27,805. Over 5 years, that's a saving of £139,023. So again, some of you are doing this already, but I don't think the tax saving is quantified as to. It's difficult sometimes when you're taking the same amount of dividends, but sometimes it's about reflecting on the other value you're drawing out of the business and how much tax you are saving as a result of this. And again, it's a compound effect. It's about reaping huge rewards through as few small changes. So if we look at will, and this is an example of bad practice from a number of clients that we've come across and helped them get into a position where they're taking money more tax efficiently. After his accounts were submitted late, the total tax bill was 30,906. The net value is pulling out the business was 58,462. He's then worked by paying his wife, paying his daughter who does his social media. He's putting £12,000 into a pension scheme because he's actually realised he needs to start saving for his retirement. He's also moved to have an electric car. He's taken his trivial benefits. His tax bill has dropped to 14,853, and the net value he's pulling from the business is 85,882. So what can you take from this presentation? Firstly, if you're being reactive to your financials, just please stop and start taking a forward-looking approach. Remember why you're in business and why you're doing it. So when you're speaking to your mate at the pub, if he suggests having an electric car, if you've got a touring caravan, that's just it, and it's just going to sit on the drive, it's just not a tactical tax decision to make. Understand what you need personally from your business. It is doing a personal budget. It's understand how much you need each month, because once you know that, you can then work backwards to the money that you're drawing. Get a plan in place. It doesn't have to be a full-blown business plan. It is just looking at income and outgoings and does that meet what I need to do for my business to deliver personally. And looking at the different methods and how they suit you. Like I've said, not all of them will suit you. And quantify the potential benefit. Even if you're doing these things now, work out actually how much tax you're saving, because when you're looking at the dividends and comparing, I have it running a business is hard, and I speak to business owners and a bit like, is it worth it for just these dividends I'm taking? But actually look at the value you're pulling out of the business and what it is delivering into your personal balance sheet. And just plan the introductions of some of these ways into the business. Even if you take the trivial benefits, that's £300 out of the company, but you're saving over £140 in tax. Now, again, I'm delivering this webinar and hopefully giving some value. So a bit of a plug for how we work at Spotlight. We work with clients on 3 levels. And again, if you're working with an accountant, these are the levels that most accountants can work with you. You might not have had the conversation with them. At core value, we prepare your annual accounts and tax return. We keep you compliant with Companies House and HMRC and make sure the taxman and Companies House are kept happy. The next level is what we call Spotlight on Track. This is where we'll work with you to build some forecasts. We produce interim accounts to see where you are on forecast, and we will explain any differences there. Spotlight on You. This is where we prepare a business plan. We have quarterly review meetings. And we have quarterly review meetings, sorry, to keep you accountable. Now, just to give the value of these quarterly meetings, we have a manufacturing client. They're a March year end. There were issues with production that kicked in May. If they'd have done it on the traditional way of accounting, they wouldn't have realised about the financial impact of those to the following December. So again, it's just if you're working with an accountant and you're not getting the information you need, speak to them, and this is your business, it needs to work for you. That wraps up all I have to deliver. There is a checklist that we're going to send out to all the attendees that you can download and have a look and see how it can impact your business. Does anyone have, there's no questions in the Q&A box. Does anyone have anything that I haven't covered or anything that they are unsure of and need a bit more clarity on? Just give it another minute. Oh. I'm just waiting, there's someone typing. Claire, if you want to, it depends on the business as to what we charge, because it's very different a business turning over 30,000 to one charging 1 million. So I will get Lucy to send you a link to book a call in with one of the team to run through and provide you a quote. Right, so Trish, if you're lending money to your business and you're not charging interest, it doesn't create a tax liability. It's only if you charge interest on that loan that it does. But again, based on your circumstances, it might be more tax efficient for you to charge interest and take the dividends. So it's one of those that needs a calculation. The other way, if the business loans you money and it can charge interest on the director's loan account to avoid the tax charge, if that makes sense. The trick with it is if you owe the business money, it needs to be cleared within 9 months of the year end to avoid the Section 455 charge. Any further questions? I can just see Kelly's typing now. I really hope that you've got some value out of it. Thanks, Anita. Again, it is really easy to forget about the trivial benefits. One top tip before I go, diarise reminding to do the trivial benefits. I forget, and literally I've got to the 27th of February and I've got to do a recce of my vouchers for the tax year. So if you diarise in your calendar, don't take the full £300 on a day. It's got to be £50. It's on separate occasions. But if you diarise it, you don't miss out on that treat. I tend to do it around birthdays and Christmas because I feel like Spotlight's giving me a birthday present for all my work. You just see if Craig's typing. Craig, it is being recorded and we'll send it out so you can watch it back. Thank you all for coming and sparing your valuable time to listen and to watch me. And I just really hope that you've got some value out of it. And any questions or queries, please get in touch with the team where they are more than happy to help. Thank you.